Hello, and welcome to this episode of Your Financial Planet, a podcast hosted by the Synergy Capital Solutions team. Join us while we share our journey as we navigate life's complexities and provide solutions to reduce the noise around your personal financial situation.
Morning, Diego.
Hey, good morning, Alex.
How are you? Thanks for joining me.
Absolutely, it's a pleasure. I'm doing great. Thanks for having me here today.
Good to hear. Yeah, nice having you on again. So we obviously always talk about various topics, and we at Synergy have kind of simplified the stages and complexities of people's lives into really kind of four different phases of build, grow, enjoy, give. Give being kind of shortly after retirement, have kind of built up your nest egg, have, maybe kids or grandkids or organizations, charities you like to give to, family you like to give to, causes you want to support, and are kind of in your stride looking to kind of share the love, so to speak, with your family and the people and places and organizations close to you. Um, so just want to kind of talk through that. I know there's a lot of this is somewhat like tax strategies, and we're not tax advisors, so we always work with people's CPAs or accountants on these things. But just wanted to get a sense for some of the strategies that we work with on clients and then kind of see how we can help people with those.
Yeah, that's a great subject, and that's this part of life is so special, right, for everybody. That's when you have built your wealth throughout your lifetime, and are you ready to share with someone that you love, when, like you mentioned, an organization that is important for you or your family. So, being part of Synergy, we deal with a lot of our clients in that situation. And there's so many wealth transfer strategies that we use, and we can talk about them the whole day, but we can point a few that we think is interesting and that we use quite often, or more often than the others. Um, Gifting strategies, for example, or qualified charitable distributions, something that we use inside a donor advisor fund. Also, it's one type of account that we use very often. So we can dig a little bit deeper into that. That a donor advisor fund, which is a type of account that some people, they wanted to donate and they want to take that out of their state, but they don't know yet who to donate to, right? What organization they want to do it, and they want to strategize this throughout the year. So this donor advisor fund, that's exactly what it does. It's an account that you can transfer this money, and you still have fully control. You can still invest inside that account. So the money is invested. You just transfer the asset to that account, and later throughout the year, you can make the donations that you want, right? All at once, or maybe one now, one at the end of the year, one next year, or whenever you're ready to make those donations. So that's a great strategy that we use inside this Dun Advisor Fund.
Mhm. Yeah, what I like about those is if clients have like a large income year, whatever, sales commissions or sold a business, something like that, you can front load it. So if you sold a business this year and your income is lower and like the years coming up, you can front load a donor advised fund with, X amount of dollars. You get that charitable contribution, like deduction in that specific year, but then like you said, it's invested, so it kind of continues to grow or maintain its principal balance, but you can then pay out distributions, for 5, 10 years to come if you like to. I like that. Obviously, we work a lot with kind of like Schwab and Fidelity. Fidelity's the largest public charity. Used to be second to the Bill and Melinda Gates Foundation, but they do a really good job of having the like research side when you mention people not really sure what they want to gift to. So you can have checks go to your temple, synagogue, church, your alma mater, if you want to, I'm a Michigan State guy, or if you want them to go to like Susan G. Komen or really anything there, I think they do a really good job of having the research side of all the basically qualified 501(c)(3)s that you can contribute to, and they do make it really easy for us to administrate, for clients to administrate, having like checks go out every month or whatever, or every year to whomever, and you can specify that they go to, like one client has it go towards the building fund at their church because they want them to continue to build physical spaces for families to spend their time at the church and things like that. So you can delineate, what charity, what time of year, what you want this specific money to go to. So I think Fidelity, who we do a lot of work with, does a really good job of making it very easy for us and clients to give money in that regard. And then how would
Yes.
you go about funding something like that with, would you look at like cash or appreciated stock typically?
And going back really quick, Alex, you made a great point because sometimes you have a lump sum that you want to deposit, and you don't want that money to go straight to the charity. So you want to make payments installments over the years. So that's a great strategy. And yes, when it comes into funding, you can donate in cash, but some strategies that we think that is more helpful is donate appreciated stocks, right? So you have that stocks that be sitting there for a long time with X amount of upside on it, and you don't want to take the capital gain, so you can donate that particular stock or a portion of that stock to that fund, and you don't have to pay the capital gains since
Yeah.
it's inside that fund. So it's another great strategy. That reminds me also to talk about gifting, right? Gifting to your children, to your grandkids. That's also something that we hear a lot when people are in that stage of their life. And you can also use that strategy of appreciated stocks and gift that to your kids or grandkids. Um, so you let us know, Alex, a little bit more about, if you don't mind, a little bit more about this strategy and how can people or the kids pay the tax on that or not pay any tax on it. It would be great to hear from you.
Yeah, college savings is a cool one. So obviously, I think like every state and then a lot of custodians like Fidelity have 529 plans, are like traditional college education savings accounts where a lot of people set them up. They have, grandkids born, they put some money away into that. And some people, you can traditionally just put cash in there. But one, I think, strategy that a lot of people don't know, but we work with a lot of clients on is similar thinking, gifting appreciated stock. We, along the same lines, you bought, say, $100 worth of stock and now it's worth 500. If you were to sell that and write a check to pay for your grandkids' school, you would pay taxes on that $400 gain, typically, 15%. But if you're going to be paying or helping pay for college that's getting more and more expensive at 20 something thousand dollars a year, that 15% makes quite a difference. So if
Yes.
you were to then transfer like the appreciated stock to your grandson or granddaughter, and then they sell it at their effective tax rate, which is probably going to be zero when they're 18 years old and just starting out school, then you don't have to burden that 15% capital gains tax up front. And then a lot of people like that strategy because then their grandchild has to get involved in the process a little bit of seeing like the money come in, selling it to cash, and then they kind of pay towards the institutions. So I think that's a really good strategy for kind of getting them involved in the process, but also all of these strategies obviously are more about doing things in a tax efficient manner. So I think the appreciated stock's a really good one to kind of segue capital gains tax that you would pay on something over time. Does add up if you have again, like 20 grand a year going towards college or, um, across multiple grandkids per se. And then along the lines of like cash gifting, I'd say is probably that's the simplest form. Every year, like you or I, like I could write you a check, you could write me a check, and so on. I think that number kind of goes up every year along with some of the other numbers in our world. Do you know what the 2025 max is for gifting or a little bit of information about that at all?
Yes, like you said, every year it's adjusted. Not every year, most years
Yeah,
they're adjusted. But yes, this year for 2025, it's 19,000 per person. So if it's you and your wife or husband or partner, each one of you can donate 19,000 for that particular person. So if you have one grandkid, so it's 19,000 that your partner can donate another 19,000.
Yeah,
And if they have siblings, you can donate another 19,000 apiece for a person. So it's a great amount. It's a great tool. Yes, you can go over that, but then it will report it to your on your taxes. So there's
yeah,
a form you can do it. That's going to be deducted from your estate. So we usually use that limit of 19 because just to make things simpler and easier.
yeah,
Um, but there are other points when it comes to people on that stage that I think is important for us to mention, Alex, is the transfer of wealth, some strategies that we use in transfer of wealth. And I'm talking about the uh, trust and wills that we sit down with our team and talk about and revisit, make sure they're in alliance to what you're trying to accomplish. I think that's a big part of what our team do here at Synergy is sitting down with those people that have the trust issue, sometimes 5, 6, 7 years old that they never sit down to reveal. And we sit down with them, with the state attorney, and do a full analysis of that trust. Make sure it's going to um, on the right path, what you're trying to accomplish on that trust. I
yeah.
think that's a point that is very interesting and important piece of what we do here.
Yeah, I think every kind of 3 to 5 years, it's probably good to. I mean, that's probably maybe more often than is necessary, but any like major changes in your family is a good time to make sure your estate plan is reviewed. One of the things I think you and I are seeing a lot is people's personal property, like their homes, maybe not being titled in trust name. I know we make the example of like your trust itself is it's basically just a fancy expensive piece of paper until you actually put anything in the name of the trust. So if you buy a house, sell a house, so on, if it's in, like you and I buy a house in joint names, something happens to both of us, heaven forbid, but it does happen, then that's going through, like more than likely going through probate, unless we were to title it in like the name of a trust, where then the trust dictates where property's going. But there's, you know, things constantly changing in people's lives, like having, grandkids, or some people have in their trust that a portion of it goes to charity and so on as people's goals change. I think, yeah, very good point of yours to change your estate plan to reflect that, because sadly, if something happens, then, whatever is most recently been written into your trust is, that's kind of the guiding principles of where your assets flow. So if you're not updating that, then that's, essentially where your money goes after you're gone is it's set in stone until you change it.
Yeah, it loses its value, right? So you spend the money, like you said, to create that trust. And if you don't update it as things change in your life, then what's the point of having that trust? Another good reminder and point, I think, a lot of people don't know, is that you can have your bank accounts designate a beneficiary for your bank accounts, put it in the name of the trust, right? Something happened to you, even if it's a joint account, like you said, something happened to both of you, that money would go to the trust instead of having to go through probate,
Yeah.
which is a big headache. So that's a big reminder. And I think it's something valid to mention here.
Yeah, that's a good point. We have obviously a lot of what we work on is the like taxable investment like trusts and then IRAs, retirement accounts and so on is kind of in our world, but a lot of people have their primary checking outside of what we manage. And then obviously we don't manage like their house. Um, but should something happen to you, more than likely the bills are going to be continued to be paid out of that checking account. But if it's not in trust name or don't have a transfer on death or a payable on death in place, then that kind of puts a burden on your family to continue to pay those bills or again have to liquidate some of your investments in order to cover that in the short term. And then obviously when you're reviewing your estate plan, make sure all that's up to date. And then I think one of the things when we mentioned the donor advised fund is a lot of people in kind of the give phase of life are having to take distributions from their IRAs now. So if people are kind of charitably inclined, say maybe tell a bit about like QCDs, qualified charitable distributions, instead of just having to pay taxes on distributions.
Yes, it's a great point that you mentioned, Alex. Some people have this retirement minimum distribution throughout the year that and they don't use it at all, right? They don't need it. So they keep thinking, and that happens not too long ago to one of our clients that they're asking us like, okay, so I don't need this, I can reinvest it. But again, I can gift it, I can do something with it. So that amount, if you decide to do a qualified minimum distribution, I'm sorry, a qualified charitable distribution, that money will be deducted for your requirement minimum distribution. So let's say you have $100,000 that needs to be distributed this year. And if you donate 20, well, that's going to be deducted and you don't pay tax on that money. So you're only paying tax on the $80,000 that it's being distributed.
Yeah.
Or so that delta, right? So that's a great strategy to use too if you're inclined to doing into philanthropy and donating to other charities and whatnot. That's another strategy that we use that I think is very valuable. And reducing taxes too, which is it's one of the things like you mentioned, we're not CPAs by any meaning, but we're always working. We are the quarterback of the team, if you will, and we always working alongside the CPA and the state attorney to make sure our clients and everyone that works with us have the best strategy in place.
Yeah. Yeah, I think if in the simplest form you think of dollars as kind of like pre-tax or post-tax dollars, if you have to take money out of your IRA as pre-tax, doesn't make sense to have to take it out, pay taxes on it, and then write a check in cash to a charity when it could go
Correct.
directly to, a church or any 501(c)(3) from your IRA and not pay taxes on that. And then I think the I would say again, like build, grow, enjoy, give phases of life. The give one is the very much like the culmination of what people work for their whole lives, take care of their family, make sure everybody's comfortable and happy. But it's a very unique time where people are trying to figure out where they want to live. They're like, do we remodel our kitchen or our house has stairs, but we're getting older? Do we move, but then maybe move into a retirement home in, 10 years? I think it's a very transitional period, both like financially and personally from where people want to live. I know we've had conversations with people about kind of navigating that, but what are some of your thoughts on like timing and how to help people navigate kind of where they want to spend their time as they kind of get older and start to try and transition to the next generation.
Yeah, and just to mention something quick, because we hearing that all the time now is that on the gifting and donating to the family members, people say I'd rather see them enjoying the money that I give them, right? And we hear that every day.
Yeah.
Then just when I pass, then I have this inheritance for them. So how can I donate and give? So those are the
Yeah.
strategies that we were talking about. And going back to your question, Alex, that ties back to the planning, right? So that's why planning for us is so important, that we can sit down and talk to you about um, all the stage of your life, and this in particular, when it's the female one, are you ready to move to a smaller house, downsizing, right? So is that something that you want to do? What if something happens to me health wise? Am I gonna have enough assets to cover for it? For me, my spouse, and what happened if I pass away, my partner, and how is it gonna be? So ties back to the planning that we do a good job at. It's putting all those scenarios and analyzing with the client what's the best, because most people did such a great job. Those people that work with us usually did a great job accumulating all this wealth, and the last thing they want to do is be worried about, oh, can I afford this? Am I going
Right.
to be okay if something happens to me health wise? So again, ties back to the planning, and that's why we sit down on a yearly basis, sometimes twice a year, 3 times a year, to go through the plan and make sure everything is the way it should be, number wise, and the goals that they have.
Yeah. I think that's a very good way to kind of summarize it. Is it all like all of this kind of comes back to the plan? So one kind of oversimplifies, but one kind of screen that says, all right, here's what you have. You have to take 40 grand out of your IRA, but you're giving 10 grand a year to charity, and you want to give, 10 grand a year to your grandkids for school. You want to give money so you're whatever, take your kids on vacation, take your family on vacation, but you need to factor in like, do you get a new roof that costs 30 grand, or do you move because you're in your, late 60s and you've been in the same home for 30 years? So I think the plan is a really good place to kind of summarize and bring everything together of like, because well, every stage of your life is a lot of moving parts, but in the give phase when people are really looking to transition wealth to their family or organizations they care about, factoring in that in addition to the normal like throughout life kind of complexities of where do I live, where do I spend my money and my time. I think the planning is, I mean, that's the that's what kind of brings it all together, and how I think the conversations we have kind of gives people peace of mind of saying, here's all that stuff that like keeps you up at night. Here's like one page that summarizes it. And this is us able to extrapolate that over time and say, you really don't have to worry. Let us worry about it. But we're here to kind of help you navigate it because we know it is complex and it is, I mean, even just any one of the pieces we talked about, like giving to charity is kind of complex. So is like college savings, like gifting is kind of complex. That changes. I mean, the amount increases every year, but some people don't know that they can just write a check to their kids if they want to. So I think, yeah, that's maybe a good way that you wrapped it up is that it all kind of comes back to the plan.
It does, and at the end of the day, we want people at this stage of life to enjoy their life, right? So not having to worry about the finance, and can I give this? Can I buy? I had this client the other day. Is like, oh, my husband was complaining because I wanted to buy something for my bathroom. I'm like, you have more than enough. You can do it. So it ties back to that. So going through the plan and discussing what's the best for them, what can they do, and what's it within the limits. You want to donate 10,000, 20, 30, 40? Is it doable? Is it not? We manage your asset, but it's so important that um that planning piece,
Yeah.
and it needs to be tied back to your investment strategy and whatnot. So that's why we work in a combination of the planning and the investment. And that's why it works for us and for our clients.
Yeah. Very cool. I like it. I think that's a good note to end on. I appreciate you joining me today.
Thank you again, Alex, for having me. Looking forward to do this more often.
Yeah, absolutely. I'll talk to you soon.
Thank you for listening to Your Financial Planet. Please press the like button below if you enjoyed this episode and hit the subscribe button so you can stay up to date on all our future episodes. The team at Synergy Capital Solutions is always here for you. Reach out to us via email at hello@synergycapitalsolutions.com, or you can call us at 888-363-4546, or check out our website www.synergycapitalsolutions.com. Synergy Capital Solutions is a group comprised of investment professionals registered with Hightower Advisors LLC, an SEC registered investment advisor. Some investment professionals may also be registered with Hightower Securities LLC, member FINRA and SIPC. Advisory services are offered through Hightower Advisors LLC. Securities are offered through Hightower Securities LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is neither indicative nor a guarantee of future results. The investment opportunities referenced herein may not be suitable for all investors. All data and other information referenced herein is from a source believed to be reliable. Any opinions, news, research, analysis, prices, or other data or information contained in this presentation is provided as general market commentary and does not constitute investment advice. Synergy Capital Solutions and Hightower Advisors LLC or any of its affiliates make no representations or warranties expressed or implied as to the accuracy or competitiveness of the information or for the statements or errors or omissions or results obtained by the use of this information. Synergy Capital Solutions and Hightower Advisors LLC assume no liability for any action made or taken in reliance or relating to any way of this information. The information is provided as of the date referenced in the document. Such data and other information are subject to change without notice. This document was created for informational purpose only. The opinions expressed herein are solely those of the authors and do not represent those of Hightower Advisors LLC or any of its affiliates.